The U.S. at risk. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today is a shocking report that nobody saw coming. I'll show you why it means we're headed into a recession. Plus, the experts say a couple interest rate cuts will turn the housing market around. We'll show you why lower interest rates will send housing prices crashing. And one retailer saying it may need to file bankruptcy. We'll show you why they're the first of many. And Democratic nominee Kamala Harris says she can save small businesses. We'll show you why we don't agree. Now let's head over to Bloomberg, where he picked today's story up with a headline: as Fed favored inflation gauges mild gains had stayed for rate cut. Today we got the personal consumption's expenditure, and it gave the market all the signs it needs that we are now headed to a rate cut in September. But that's only the good part of the report from a market's perspective. When I show you what's coming, it's going to be conclusive evidence that we're headed into a recession, this time led by consumers. Let's take a detailed look here, because the so-called core personal consumption expenditures price index, which strips out volatile food and energy items, increased 0.2% from June. On a 3-month annualized basis, a Metre economists say paints a more accurate picture of the trajectory of inflation. It advanced 1.7%, the slowest this year. So what it's telling us is we're right on track now to reach the Fed's 2% target. So fears that we were going to see a resurgence in inflation. Now remember, this is something consumers thought was going to happen, the market thought was going to happen, and even the Fed thought was going to happen. We told you it was not likely, and now the data is starting to validate that we are getting right on track now for a September rate cut. As inflation adjusted consumer spending climbed a whopping 0.4% on an acceleration from the prior month. So what you see here is what appears to be a soft landing, but it isn't that at all, because while inflation is cooling off and you see an increase in spending, all that spending has been led by more debt. And that's not a good sign here, because as you're about to see, incomes are coming down. But when we look at the year-over-year rate of change, we see the PCE is at 2.5%, the core just a little higher at 2.6%, and real consumer spending driving higher at 0.4%, which indicates what we're kind of seeing in the data. There appears to be demand from consumers, but this isn't going to last a whole lot longer. They just can't afford higher prices, and they can't afford to take on more debt. But from the personal consumption's expenditure data, we can now see conclusively we are on a downward path here in terms of inflation. The problem is it means demand's coming down as well. Fed officials have indicated they're more focused on the employment side of their dual mandate, in part because of the trajectory of the labor market will help inform expectations for consumer spending. And this is the key point, because consumer spending is the main engine of the economy. And when people hit the unemployment line, their incomes go down and their spending power goes down. And that all of a sudden brings inflation down. And this is a concern the Fed has, because as more and more people hit the unemployment line, which is not what they want now, it brings inflation down, but it also brings the economy down with it. And that's why when you look back through history, when we see large increases in the consumer price index, it precedes a recession 100% of the time. The Fed has the absolute worst track record of trying to bring inflation down without damaging the labor market. This time will be no different. And the highly anticipated August jobs report is due next Friday and will be the last the policymakers see before their September 17th and 18th meeting. And based on the current data, it's unlikely that next non-farm payroll report is going to see an upside surprise. It's likely to continue its downward trend. But let's take a look at some charts here, because the consumer price index is really a function of demand. As we look at that on a year-over-year rate of change shown in blue against the unemployment rate, and this is the U3, and we hear the Fed talk about the U3 unemployment rate all the time, and they wanted to see people go on unemployment, but there was a limit to what they wanted. We heard from Fed Chair Powell at Jackson Hole, Wyoming, that we've reached that line now, and he's growing concerned. He wants to put some rate cuts on the board because what you see happening here as more and more people lose their job, yes, inflation can go higher, but only in the short term before you see a massive slowdown. And it happened again in the dot-com bubble, in the global financial crisis. We had all-out deflation as oil prices came crashing down, and now we see the same trend happening again. Inflation's coming down, but at the sacrifice of the U.S. labor market. And while layoffs remain low, weaker demand for workers is starting to translate into less purchasing power. And this is exactly the case I've been making, that producers need inflation to continue to give out higher wage increases. If inflation comes down because demand comes down, well, that means wage growth is slowing. And sure enough, that is. Now, keep in mind, we saw spending was up 0.4%. Well, look at this. Wages and salaries climbed 0.3%. Now, that is a slight pickup from June, indicating that exactly what we're seeing from consumers is they still don't have the income to keep up with inflation here, so they're having to borrow the difference to maintain their spending power. But that was well below most of the gains back in 2023. And look at this. On an inflation-adjusted basis, disposable income growth barely rose. So what it's telling us is there is no money on the disposable side. We need to see an increase in disposable income to deal with the higher prices that, of course, companies want to charge. They need to charge. We're not seeing that. That means demand now on the discretionary side confirmed to be going down in a long trend. But here's the big one. This is a shocker in the report. The savings rate slipped to 2.9%, the second lowest reading since 2008, and this is a dangerous sign for the economy. But maybe you're looking to make some extra money or just turbocharge your trading account or just be on the right side of the market. Well, we are looking to make a big upgrade to our reports here. One of them coming hopefully in the next week. I'm going to show you the data. Look at this. As of the close of business yesterday, and this is 100% duplicatable. I want to stress that. Our CTA Timer Pro, 19 open trades, 18 of them are up, 95% win rate. We closed 2 trades yesterday for a total 0.93% gain. Momentum Time Pro, see on 6 open trades, all of them are up. 2 trades closed out yesterday, plus 0.92% between the 2 of them. And here's what's exciting. We back tested, we built a custom engine, back tested all the signals. You see these in green? That means it has a 50% chance or more historically of rising over the number of days. We tested it over multiple lengths here. This is going to be made available to all our subscribers very soon. When it comes out, though, look for the price to go up for new subscribers, because when you're armed with data knowing you're putting in a high probability trade, well, you're going to make a ton of money. And this is coming out for our CTA Timer Pro, where we look at the machine positioning across the broad equity, bond, currency, and commodity markets. We look for a flip in the machine positioning. That flags our report. Maybe you trade momentum. We're working on this one next. We make that work as well. We're going to give you all the stats on that. You get the daily reports, the tradable signals, my opinions on the best trades, the stop loss levels, tracking of all the trades and returns, updates every week, every Saturday on the stop loss levels, a free trial, and soon to come, a way to give you the edge. You will find the highest probability trades so you can make money. But let's talk about who's not making money, and that is workers who are seeing their pay increases continue to slow. As we look at the average hourly earnings of production and non-supervisory employees against the unemployment rate here, and you can see once we started moving into a globally synchronized economy, at least in the early phases of it here in the late 1980s, you'll notice now that as we see a decrease or deceleration in average hourly earnings, what happens? The unemployment rate goes up. So that was flagged in the report about personal consumption indicators. That was a huge concern here. And this is a case that I've been making over and over, that as more people hit the unemployment line, that employers don't need to give out big raises because there's an ample supply of workers that they could go pull from at any time. And so you see the relationship here is nearly a mirror of each other, suggesting that this recent and prolonged deceleration of average hourly earnings is going to lead to a continued increase in the unemployment rate, which is why we're starting to see signs that the savings rate, now at the second lowest level since 2008, is telling us we're headed right into a recession. The policymakers, the political elites, they're way too late. They can't stop this from happening. And if you think a couple rate cuts will do it, it won't at all. Because when we look at the personal savings rate against the U3 unemployment rate, we find a very interesting relationship. When savings rates get to very low levels, and I want you to think about this, what would get people to save more, lower rates or higher rates? And that's really the catch here, because the Fed wants to lower rates. It's really a disincentive to save. The problem is that U.S. consumers here are very low on savings, and at some point when it gets down to low levels, well, they cut their spending. And here you can see that relationship as we look at the personal savings rate against the U3 unemployment rate. As you see increases in savings, it leads to less demand and more people on the unemployment line. So you see this relationship happening over and over throughout time. As we look at right now, we're at the second lowest level since 2008. There is a point where consumers are going to say, look, I'm growing concerned about my job. I'm not getting the hours I want. We need to build up our savings. We need to cut our spending. That gets cut on the discretionary side, leads to more people getting hours cut, losing their job, and a rise in unemployment. That is the risk here. And you can see that this trend precedes recessions. So it's saying the moment consumers have had enough to start saving money, it's game over for the U.S. economy. And we can even see it means inflation's coming down as we look at the personal savings rate against the consumer price index, that now shown in red. And you can see as consumers save more, what it means is demand comes down. And that, of course, tells manufacturers, wholesalers, and retailers they need to cut prices. It brings inflation down, but not in the way you want, because once again, it's at the sacrifice of the labor market. So we can see already now that a rise in personal savings helped bring inflation down. Consumers spent down their savings a little bit, buying into the soft landing narrative. It really didn't help inflation much, but as soon as they start putting more money in the bank, well, that means inflation's coming down and people are going to lose their jobs. There's nothing that we can do to stop this. But yet many people believe that rate cuts are the answer to everything, including the experts in the housing market. But we think lower interest rates mean home prices are going to come crashing down. As U.S. pending home sales gauge now drops to the lowest on record, the index of contract signings decreased 5.5%. That's a huge number to 70.2 in July. But look at this. The National Association of Realtors says, look, we just need falling mortgage rates, and that will solve everything, but it doesn't. The drop was larger than all estimates in a recent survey of experts. And here you can see contract signings index hits a new low in July. I mean, we're talking depression level contract signings here. You go back all the way to the worst part of the dot-com bubble, the worst part of the global financial crisis. And many people say that their house is going to hold its value. Well, looking at that chart alone, it says we're on the cusp of a housing crash as well. A positive impact of job growth and higher inventory could not overcome affordability challenges and some degree of wait and see related to the upcoming U.S. presidential election. And that's simply because what did we find out from the government? That the BLS reports, the non-farm pay reports were overstated. So that means the jobs market wasn't as strong as everybody hoped. And how about this? Higher inventory. Well, what did builders do? They kept raising prices. So that didn't have a factor at all. Now we have a problem is builders are sitting on a massive amount of inventory. We're seeing the economy slowing, which means they're going to be forced to cut prices to move the inventory, which in turn is going to hit the resale market in a big way. Because when we see the unemployment rate continue to rise, which we now know is a foregone conclusion, just a matter of time before consumers start saving money, it's game over here. We look at this against new privately owned housing starts. It's obviously from builders, and what we can see is housing starts go down as more and more people hit the unemployment line. And right now, builders are saying they've got a very large inventory. The Association of Realtors say we just need a couple rate cuts. And what we're seeing in the labor market says is none of those are going to matter, because we know rate cuts are not going to help people keep their job. What it means is we're going to see more people lose their job. Housing starts are going to come down, and that means home prices are going to come down with it, because one thing people don't realize, builders have margin to cut their prices. People on the resale side, not nearly as big. And as builders cut prices, that's going to put pressure on those that are in their homes now looking to sell. And next thing you know, you're going to see an all-out crash in real estate. And lower borrowing costs would help ease one of the least affordable housing markets in history. Well, it's going to get even more unaffordable as people hit the unemployment line. An index of U.S. home prices by S&P CoreLogic Case-Shiller hit a fresh low record on Tuesday, with prices up 5.4% in the year through June. And this is, again, it's coming down to the one thing the Fed said they didn't want to see, and that was the U.S. labor market come unwound. Well, now we're about to see it happen as the personal savings rate touches the second lowest level since 2008. The moment it goes up, well, it's over, because lower interest rates generally do not always lead to an improvement in demand for housing. We can go back and now look at new privately owned housing units started in blue against a 30-year fixed mortgage rate. So here you can see in the late 80s going into the early 90s, the housing starts were coming down, and that meant prices were coming down and interest rates went down, and that didn't change anything. That happened again here heading into the dot-com bubble before lower rates did help out. But remember, there was a huge demand for housing by boomers. But how about going to the global financial crisis? Housing starts came down, home prices started to come down, interest rates came down, didn't stop it at all. Now we're seeing the two headed together. There's no chance that lower interest rates are going to stop what's happening in the housing market, because people that don't have jobs, well, they can't buy a house. And if we look at the yield curve, what we find out is this has a lot to do with financial conditions tightening by banks. So even if interest rates go down, people aren't going to be able to get a loan. That's something they're missing the other side of the story here. You see that lower interest rates don't bring demand, but part of it is because it's not just the labor market falling apart. It's the fact that the banks don't want to lend as rates go down against falling prices. This is an issue here as we look at the yield curve, now shown in red, and it's shown inverted anytime it's underneath that horizontal green line. And you'll notice that when it comes out of inversion, because rates are going down, what happens to housing starts? Well, they continue to fall. You see that happen every time except coming out of the dot-com bubble. Again, this had everything to do with the boomer demand for housing, but you look at this other times, you see that housing starts continue to fall. That means builders are cutting prices. The resale market sees itself price coming crashing down, and that leads to a bubble bursting. And you see we're in the beginning of that phase now as a yield curve looking to break out into a bull steepener as the market is pricing in lower rates. And that, my friends, is not bullish for housing prices. But one retailer saying they might have to file bankruptcy. They're going to be the first of many, because Big Lots is considering bankruptcy filing after a sales slump and may be looking to see court protection within weeks. During the next recession, there's going to be a long line of retailers because they're all going to be in trouble, as Big Lots received a loan earlier this year to help navigate its liquidity crunch. So it's out of money, and that has been seeking additional financing in recent weeks because sales continue to slow. And that's a problem, because in this cycle, we have an issue where companies have too much debt and they don't have enough revenue to service it. And that's really the interesting thing. We look back to the dot-com bubble, there was a lot of speculation in that. We look at the global financial crisis, there was a lot of speculation going into that. This cycle, it's a matter of too much debt and not enough growth. It's a whole different animal here, because Big Lots is among troubled retailers that have been hurt by a slowdown in home spending that's going to get worse as more people hit the unemployment line. Furniture retailer Conn's filed for bankruptcy in July. LL Flooring Holdings, formerly known as Lumber Liquidators, well, they liquidated themselves as they filed this month. It's only going to get worse. But can Democratic nominee Kamala Harris save small businesses? Well, she's proposing a tax credit to help them. Well, I don't think it's going to work because it's too little too late. Now, on one argument, you're going to have a lot of people on the unemployment line wanting to be self-employed because there won't be any jobs, but this isn't going to help them. What I'm going to be rolling out next week is basically a tax credit for startups for small business. A tax credit is the latest piece of economic agenda Harris has slowly unveiled since jumping into the presidential race just over a month ago, following President Joe Biden's exit from the contest. Problem is, no matter who's elected, we're heading to a recession. Tax cuts to get people to start businesses, it's not going to be the answer when more and more Americans are hitting the unemployment line. They're going to see their housing prices come down. There's going to be mass foreclosures. There's going to be mass amount of delinquencies, and this is not going to be the answer. What is, we don't know, but we'll be there with you when it happens. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.